Welcome to the deep dive. Today, we're getting straight to the point with bonds.
Yeah, let's do it.
You've got questions, I know, especially with interest rates doing their thing lately.
hmm
So our mission today is really just to make bonds clear, relevant for you. So maybe start basic. What is a bond exactly? How is it different from, say, a stock?
Right. Well, think of a bond fundamentally as you lending money. Simple as that.
Okay.
When you buy one, you're essentially giving a loan to maybe the government, could be a local authority, or even a company.
Ah, okay. So not ownership like a stock.
Exactly. With stocks, you own a small piece, a slice of the pie, right? With a
Yeah.
bond, you're the bank, you're the lender,
Gotcha.
and they promise to pay back the principal, that's the original loan amount, the face value on a specific future date. Plus, you get regular interest payments along the way.
Okay. Lending money. Got it.
Hmm.
So who are these main borrowers we're talking about here? Who issues bonds?
Good question. Primarily, you're looking at government bonds,
Yeah.
things like sovereign bonds issued by national governments.
Right, usually in their own currency. And treasury bonds, often a specific type of government bond. Generally, these are seen as pretty low risk.
Lower risk. Okay.
Then you have municipal bonds, or munis. They come from state and local governments. Think funding for roads, schools, that kind of thing.
Local projects. Makes sense.
And finally, corporate bonds. These are from companies, raising capital. Generally speaking, the risk ladder kind of goes government is lowest, then municipal, then corporate.
I guess corporate bonds might offer higher returns to compensate for that extra risk.
Precisely. Risk and potential reward.
Okay, right. Now, about that interest, you mentioned payments. The coupon, right? How does that actually work for the investor, for me?
Yeah, the coupon. It's basically the stated interest rate on the bond, calculated as a percentage of its face value.
Okay.
So let's say a $1,000 bond has a 5% coupon. Typically, that means it pays $50 per year.
Ah, okay. Usually split up.
Yeah, often paid out twice a year, so $25 each time. It's generally a fixed payment throughout the bond's life. And the maturity date, that's just the end point, when the loan is done.
Exactly that. It's the specific date when the borrower repays the full face value, the principal, back to you. The debt is settled then.
Okay, now this is the part I always find, well, a little tricky. Why do bond prices and interest rates seem to move in opposite directions? That inverse relationship.
Yeah, it trips people up sometimes, but it makes sense if you think about it. Imagine you buy a bond today and it pays, say, 3% interest.
Okay, got my 3% bond.
Now, tomorrow, overall market interest rates jump up to 4%. Suddenly, brand new bonds being issued are offering that better 4% return.
Right, so my 3% one looks less appealing.
Exactly. If you wanted to sell your 3% bond before its maturity date, nobody would pay full price for it when they can get 4% on a new one.
So I'd have to sell it for less.
Discount it. You'd likely need to lower the selling price to make its total effective return competitive with those new, higher-yielding 4% bonds.
And the reverse is true. If rates fall, my bond is worth more.
Yep. If rates drop to 2%, your 3% bond looks pretty great, and its price would likely go up if you tried to sell it.
Makes sense.
Okay.
But what if the borrower just doesn't pay the interest or the principal back? That seems like a risk.
That's a very real risk. It's called credit risk or default risk, the chance the borrower might not meet their obligations.
How do we know how risky a borrower is?
Well, that's where credit rating agencies come in, companies like Moody's or S&P. They analyze the borrower's financial health and assign ratings.
Like grades, A, B, C.
Sort of, yeah. Higher ratings, like AAA, suggest very low risk of default. Lower ratings mean higher risk. And generally, lower rated bonds have to offer higher interest rates, higher coupons to attract investors.
Right, compensation for the risk again. Now, I've heard terms like yield to maturity and current yield. Are they the same thing?
Not quite, though they're related. Current yield is simpler. It's just the annual coupon payment divided by the bond's current market price.
So the immediate return based on what I paid now?
Exactly. It tells you the return you're getting right now on your investment price. Yield to maturity, or YTM, is, well, a bit more comprehensive.
Okay.
It considers all the future coupon payments, plus the difference between the bond's current market price and its face value, the amount you get back at maturity. It assumes you hold the bond until that maturity date.
Ah, so it accounts for whether I bought it at a discount or a premium.
Precisely. That's why they can differ. If you buy a bond for less than its face value, your yield to maturity will be higher than the current yield, and vice versa.
Got it. So it's not just the bond itself affecting things, but the wider economy too, right? Like inflation.
Oh, absolutely. Inflation is a big one. It eats away at the purchasing power of future fixed payments like those
Yeah.
bond coupons and the principal repayment.
So if inflation is high, bond investors want more interest.
Generally, yes. High inflation often leads to demands for higher interest rates to compensate for that loss of value. And broad shifts in the general interest rate environment, often steered by central banks, directly impact existing bond values because of that inverse relationship we talked about.
Okay. I've also heard people mention bond ladders. What's the strategy there? Is that a way to handle some of this uncertainty?
Yeah, it's a popular strategy, especially for managing interest rate risk. A bond ladder basically involves buying several bonds that mature at different times.
Like one matures in 1 year, another in 2, another in 3.
Exactly. You stagger the maturity date, say 1 year, 2 years, 3 years, maybe out to 5 or 10 years. As each bond matures, you get your principal back.
And then you reinvest it.
That's the idea. You reinvest that principal, perhaps into a new longer-term bond at the end of your ladder. If interest rates have gone up since you first invested, you can reinvest that money at the new, potentially higher rate.
Ah, so it helps avoid locking all your money into low rates if rates rise later.
Right. And it also provides some liquidity as you have bonds maturing regularly. It helps manage both interest rate, the risk of rates rising, and reinvestment risk, the risk of rates falling when you need to reinvest.
Okay, that makes sense. So let's tackle the big question head on. Are bonds actually a safe investment right now? Especially if people are worried interest rates might be rising.
Well, safe is always relative in investing, isn't it? It's nuanced. If you already hold bonds, particularly longer term ones, and interest rates rise sharply, yes, the market value of those existing bonds could decrease.
Okay, that's the downside.
But on the flip side, if you're buying bonds now, or as rates are rising, you get to lock in those newer, higher yields, which means more income.
So new money going in gets a better deal.
Correct. And strategies like the bond ladder we just discussed are designed specifically to help navigate these changing rate environments. By having bonds mature periodically, you get chances to reinvest at potentially better rates.
So it's not a simple yes or no. It depends on your situation when you bought what you're buying now.
Absolutely. It really hinges on your individual investment timeline, your goals, and your tolerance for seeing potential temporary dips in market value versus locking in income.
Okay, great. So just to quickly recap the key things. Bonds are essentially loans you make.
Mhm.
Different types exist: government, municipal, corporate, each with different risk levels.
Yep.
Their prices generally move opposite to interest rates.
Yep.
That's crucial. And there are different ways to measure yield. Plus, strategies like bond ladders can help manage the risks.
That sums it up nicely.
This has been incredibly helpful, really cleared things up. Now, for you listening, maybe you're thinking about how bonds could or maybe couldn't fit into your own financial strategy. Considering what we've discussed, what other questions pop into your mind as you think about navigating the bond market yourself? It really comes down to aligning these kinds of fixed income options with your personal goals and just how comfortable you are with different levels of risk. Thanks for taking this deep dive with us today.